Hi, this is Ron Janish, and this presentation is about signals for the software we are in the process of making. Let's do a little history on signals and software. Typically, investors like to use lagging indicators, so they'll use something like a crossover moving average system, and that's when in this particular case, it's a weekly chart of the Dow Jones Industrial. It's when the blue line goes above the red line. This is nothing more than the 50-day moving average versus the 200-day moving average, and the theory is when prices break under it, it's a time to get out, and when they go back above it, it's time to get in. And as you can see and imagine, there's quite a bit of whipsaw in this process here. However, this is widely used, this particular moving average or similar ones, because there are times when it does reasonably well. Now, what some people have done is they've added something called an oscillator, and when you add an oscillator, here's a stochastics 1433, and it's just what people do is they look at this, they say, well, down here is oversold, so here's a time to buy, and when price go up here is overbought, so it's a time to sell. The problem with this, of course, is that it's not really true, because as you can well see here, this was actually a wonderful time to buy, and look at how nicely prices went up after that. So this oscillator technique alone, even combined sometimes, doesn't work really well unless you take it to the next step further, which is using a much more sophisticated oscillator in conjunction with a moving average like that. So what you might do is, oh, well, you only buy when it's in the overbought territory and you get a signal, like over here, and you take the ride up here. Here's the X, gets you out, boom, and you wait until you have another buy signal here, and you make sure that you're in overbought territory. There you are, you're in overbought, and X gets you out again once the blue line goes under the red line, and here it happens again, overbought territory. Now this seems to work reasonably well. So what happens is people will look at this and say, wow, this worked from 2003 to middle of 2007, and now we can do a walk forward test to see if it works in the future. So let's just do that. Oh, there's a walk forward. Hey, looks great. Kept you out of the crash in 2008. Beautiful. Kept you in the money afterwards, right? Nice, nice. Hey, looks good so far. So here's a further walk forward. Looks good too. Hey, looks absolutely terrific. Here's the danger in this kind of thing. So what happened here is suddenly there was a buy down here and there was an exit signal here, which wasn't achieved until prices had already crashed big time. So it really has quite a bit of danger to it, and this would have resulted in a substantial loss, probably somewhere 30% or so of the position itself. So it's a pretty hefty drop. Are there better techniques? Probably. One of the things that I like to use instead is something called geometry. And I can tell you that from my own experience, when the market was over here, in 1987, I was in front of a class in a high school in New Jersey. No, I'm sorry, in Sunnyvale, California. And it was Homestead High School, Sunnyvale, California. And it was the week before the crash. And I was telling the kids that the best time to buy options, and probably the only time that's reasonably safe, is when you have a very good indication the market's going to do one heck of a move that you can forecast, so that you can buy some options with very, very low risk and very, very high returns. And this is what we were forecasting at the time using market geometry, and I'll show you some of that in a moment. So anyway, let's take a look at some of that. But rather than just fancy historical charts, let's see some real proof. Well, this here is a little chart we posted on CNN. Drew a line up here, and this is just a line, but the trick is knowing when to actually draw the line. That's really important. And we say here the fattest lady is sung, and the reason this is the fattest lady is sung, not just the fat lady, is because this is the financial sector index right up here, and Sure enough, the idea is that this is the high and it's down we go from here. Now this was posted on CNN. They're not going to lie for me. They'll just, if I put it up there, I put it up there and we see what happens. So let's see what happens. Boom. This was the line. Here's how nicely it dropped. Okay, let's move on. How about another forecast a few days later? Well, right before Easter on 4/14, we were predicting a substantial surge in the stock market. Called it a resurrection rally because we knew it was going to go into the Easter holiday. So let's see what happened afterwards. Sure enough, a few days later, boom, market was up there nicely. Now, we use different indicators for each of these things. So now, can this be done with fine tuning? So in other words, can we take something like the Dow Jones and say, gee, here's a 15-minute bar chart, and this is very, very likely the top that's going to go down for a good amount of time? Well, let's see. Posted on CNN on March 7th, 2014. Boom, this was it right there, March 7th, 2014, and down she went. Wasn't the all-time high, but it went down enough to make things very interesting. Okay, so who invented this stuff? Actually, it was invented by Roger Babson, the founder of Babson Business College. He taught it to Dr. Alan Andrews, a good old friend. And was it taught to anyone else? Well, Dr. Alan Andrews used to conduct seminars, and so he taught it to me. Now the question here we have up here is there someone else? Here's Dr. Andrews, and here's somebody else, namely me, teaching at the seminar. So is it available today? Yeah, you can still get it today. You can buy the Andrews course, or if you really want to do it right, you get the expanded Andrews course, and you can learn quite a bit. Now, will they stop teaching it soon? Probably, because the people in this particular organization, namely me, are working on developing a new software that will take over the analysis that's being done today. And the new software will have various signals that manage the trading. You see, the problem with using the Andrews technique is it's like throwing around a bunch of balls at one time and trying to keep them in the air. That's what makes it difficult. So it'll give you an idea as to some of the signals. Well, let's first of all take a look at a test. Okay, what we did was we did a historical test, and this is a real-time test rather than just a historical study where we said, well, this should have happened. So what happened is on a regular basis, we put these orders in to a service that costs us like $120 for 6 months, and this was what it looked like after a few days. And you can see here was the Australian dollar. Let's keep an eye on this one here. Okay, and here's another one. Here's natural gas. So Australian dollar is down 120 and natural gas is up 230. Okay. And so this is what the test looked like because we started at the beginning of April. And this was what things looked like in the middle of April. And then the very next day, well, the Australian dollar is positive and natural gas is down a bit. But it has these other positions in there. And then wound up putting in a few more buys and a few more sells order. And sure enough, Australian dollar is now positive a little bit, and natural gas is up a bit. And we can see the chart's looking like this. It's doing okay, a little choppy, but going up. And here we see a few days later, and there was profit taken in quite a few, and there's various winners and losers. You can see here the Australian dollar is now up $3.40, and the natural gas is up $16.20. That's not bad. So the chart is automatically updated, and this is a service that we use that we pay for. Okay, and so what we did was we took the numbers out and looked at where the profitability is. In other words, what works best. Is it futures? Is it currencies? Stuff like that. And is there something we can quickly eliminate? So we looked at, for example, a futures only test. And so we looked at this and we found that if we eliminate Chicago, we can if we eliminate non-Chicago trades, in other words, trades made in New York, we can increase the theoretical profitability on this. So what are these specialized techniques? Well, these are some of the buzzwords that we've kind of made up for these different things, kind of labels, if you will. Let's give you an example. Let's take EP. EP is a pattern. Notice when something goes up, this is the SPY, which is the S&P 500. Normally it goes up, down, just up, down, up, down, up, down. Sometimes it does an EP, and that's when it goes up, boom, makes a lower low, and then boom, makes a higher high. And that's called an EP pattern, and those are kind of interesting and can be used for a signal. But they're dangerous. See, now here was the EP top in the S&P, SPY, in 2008. See how nicely it helped in finding the top? And with the EP, which is up here, notice that sometimes prices will break through it and go back up to it again before going down a whole bunch. And sometimes you have your EP pattern in here, and prices go up, they come down, and then they finally take off. So one of the problems with using the EP is that, well, geez, what do you do? Because there's a whole bunch of different entry triggers when that pattern is there. That's why software comes in handy. Now here's an EP recently in CBS suggesting that this was in for a good down move. And here's one in international finance. This was the iShares Global Financial ETF. Here's your EP pattern. And there's one in the Russell. And if you look at an updated Russell chart, I think you'll find that it went a heck of a lot lower than this. And here's your EP in natural gas. Here we go. Boom, notice the nice quick move. And here you have your EP in natural gas for the up move. And so you have these. One of the things you can do is you can use Roger Babson's reaction lines, where you wind up getting out over here because down here it bounces off one of these lines. And you can use them on a 60-minute day intraday, 60-minute chart intraday. See how nicely it went up here? And here's another recent one with a 60-minute, and here you see where the EP was, and down there is this exit. See? Now, the benefits of the software is it monitors markets to find signals. It monitors various time frames, gives you an entry point, and the investment can be based upon reasonable risk analysis, realizing that when you deal with history, it's all hypothetical. Ain't really the real thing, but hey, you got to start somewhere. And an investment, of course, is based on funds available in the account, and the software knows when to exit as a result of extensive historical studies and historical tests. Here's an example of what we call the sandbar signal, and so it wound up getting a sell in here for it to go down a ways. Here's another example of what we call the sandbar signal, and this is one of the other signals that we'll wind up using in conjunction with this. Here's a sandbar buy signal in T-notes. See that down here? Okay, and then another signal we're going to wind up using is called the new Andrews Pitchfork indicator. You can see the update of that at andrewspitchfork.com. Another thing we're looking at using is something called a fake 4. And here's a nice example of a fake 4. Oh, there's an EZ, the EP pattern that we talked about earlier. See, one of the problems is, and challenges and opportunities, is that in a matter of a few days, you'll get several different patterns. And it's a matter of keeping track of all this stuff. And here's another combination, once again, combination of the sandbar and the EP, and then you even have a fake 4 over here. So you can, as you can see on this one chart here, there was all kinds of different signals. And then another signal we're looking at, and that's called a zoom at the C and then a failure. Another one we're looking at is a 3Q signal. And and sometimes you'll have the fake 4. There's a fake 4, and there's the went to the target, and then you'll have an EP and a 3Q signal, and it just goes wild. And then you have the GPR0, GPR2, and so there's a lot of advantages of the software. And Now, and the advantage is that the software will be able to trade with multiple time frame analysis. And the software does not forget signal parameters. And the software remembers all the signals and when to do what. And the software is not emotional. Now, fact of the matter is, we're going to use historical studies, which, as everybody knows, when it comes to investment, it's kind of like a lumber yard. You can build anything you want with it. But if you have something that's really, really good and solid to start with, I think there's a better chance, personally. So that's what we're going for. We're going for the stuff that we think has a much better chance. Let me see what does it say next on here. Now, what the software is going to do, because we haven't built it yet, it's going to examine each market multiple time frames, calculate line locations, calculate which pivots to use, detect entry and exit and reversal signals that are based upon which entry, exit, and reversal signals we tell it to use in which market. And chances are most of the markets take pretty much the same thing. It's going to calculate risk for each trade and portfolio. It's going to place entry, risk, and exit orders and take profit orders, and it's going to keep track of any and all accounts that it trades with. And can it improve performance? Or what can improve performance? Well, things we'll look at is what's the average win-loss per signal? What signal combination is really powerful? What is the best for an entry signal? What's the best for an exit signal? And what's the best system for any particular item? I want to say item, let's say security, be it Forex or be it Forex like euro versus dollar or whatever. And also be able to historically model when money management is applied in different ways, because good old Ed Zakota, who made his fortune trading, said that it's just 70% of having a sense of where the market's going, and 20% of really good money management or knowing how much to put on when, and 10% is really the system you use. And then the other thing we're going to be able to do is have a combination of short-term and long-term signals. Now, if you build a business using something like this as a basis, remember we haven't built the software yet, is what you can do is you can get money management fees that are typically 20-30% of the profits. You can get annual administrative fees, and if you take it a bit further, you can work with the introducing broker and wind up getting fees of $1 to $3 per trade, which some clients might think is a conflict of interest. So you might want to temper that. Anyway, that's what we're looking at. That's the software. If you want to check me out, no problem. Go online, check me out. This is the project. What we're looking for is for people who are going to be investors in this project. We think that the project is going to take probably 9 to 18 months, let's say 18 months minimum, but we'll be able to get some interesting things done in 9 months. And this is where we're going with it. So if you'd like to join us in this project, let me know. There's risk to it, and the risk is that it won't work. You need to know that. Absolute risk that it won't work. Risk that we have a certain person we're looking at using as a programmer. Risk that something might happen to him. We'd have to find a replacement. Building any kind of a product, there's always risk galore. Now, what we've done to mitigate the risk is we have already chosen a platform to use, which means the software we're going to be building is pretty much 90% built and has been around for a very long time. That's a good thing. So, because that's less stuff that can go wrong. So we're going to be building signals to go onto that software, okay? So if you have any questions, please email me, ronj@san.rr.com. I can be reached at 858-487-5151. Thanks.